Electric vehicles, microchips, and life-saving pharmaceuticals all share a hidden dependency. They rely entirely on ultra-specialized chemical intermediates to function. Manufacturing these underlying materials requires navigating extreme purity standards and aggressive global regulations. Very few companies can clear those barriers. Acutaas Chemicals, formerly AMI Organics, found a way to turn that exact bottleneck into a distinct advantage. Look at this timeline. In 1998, they started with a single 33-kiloliter lab. Today, they operate 5 manufacturing facilities across 55 countries, projecting more than 11.7 billion rupees in revenue for fiscal year 2026. This growth is the result of a highly specific 3-part playbook designed to build economic moats. To dominate a modern industry, a company doesn't need to build the final product. They need to own the invisible layers that make those products possible. The first move centers on their foundational business, pharmaceuticals, which drives 87.7% of their total operations. Within that sector, they command a 50 to 90% global market share for key pharmaceutical intermediates. This chart shows how they maintain dominance through backward integration. Pharmaceutical brands rely heavily on the intermediate layer to produce drugs. Acutaas manufactures over 90% of these intermediates by producing basic chemicals themselves, completely covering the supply chain. Internalizing that supply chain gives them total control over quality, allowing them to secure compliance from strict global regulators and effectively lock out competitors. This self-reliance directly fuels their highly profitable contract manufacturing operations, particularly for fast-growing chronic therapies. In the high-stakes world of modern manufacturing, controlling your own raw materials provides the absolute strongest defense against any sudden global supply chain disruptions. The second move targets the semiconductor industry. This sector requires chemical purity measured in parts per billion, an incredibly high technical barrier. Rather than spending decades attempting to develop this level of purity from scratch, Acutaas leveraged their pharmaceutical revenue to buy first-mover advantage. They acquired a 55% stake in Baba Fine Chemicals and established Indichem Incorporated as a South Korean joint venture. The payoff was immediate. They became the sole manufacturer in India for photoresist chemicals, instantly opening supply lines to tech hubs in Japan, South Korea, and Taiwan. When a market is protected by extreme technological complexity, executing a strategic acquisition provides a faster route to entry than internal development. The final playbook move is visible in a specific anomaly within their financial portfolio, an entire division generating 0 commercial revenue. That division houses their indigenous research and development operation for electric vehicle battery chemicals. Here, they are pioneering electrolyte additives, making them the first manufacturer of these specific compounds in India. The pipeline currently holds more than 10 products in development, including vinylene carbonate, with at least 5 global customers already actively validating their samples. True corporate longevity requires sacrificing short-term revenue to build the foundations of future market control. By executing these 3 moves, the company evolved from a localized pharmaceutical supplier into a multi-vertical global specialist. This evolution materialized in 2025, when they surpassed 10 billion rupees in total sales. Reflecting this scale, they officially rebranded the corporation to Acutaas Chemicals Ltd. In just over 25 years, they scaled from a single 33-kiloliter lab to managing the world's most demanding chemical supply chains. The future belongs not to the brands that assemble final devices, but to the architects of the invisible chemistry that make those devices exist.